Welcome back, everyone, to Vox Markets Live. My name is Paul and I'm delighted again to be joined by expert analyst and capital markets commentator Paul Scott to discuss all things small caps. So welcome, Paul.
Thanks, Paul, and hello to everybody again.
Yeah, well, we've had a really busy week, both of us. We've been up in Derby presenting at the Mello conference. So maybe we start there. What was the sort of like the general vibe and the outlook for 2025 that you picked up from investors? Because there was hundreds of them.
I would say despondent. Yeah, no, I really would. I think a lot of people are just absolutely fed up with this. What certainly still feels like a grinding bear market in small caps, although there are still plenty of small caps that are actually doing really well and hitting new highs. It's just a question of whether you've got them in your portfolio or not, isn't it? So no, but I think there's still a lot of interest in small and mid caps. Obviously some money's being sucked out into America, but yeah, still people are seeing the bargains, they're seeing the takeover bids. So yeah, I think that it won't take much to move sentiment back up, I think. But obviously I don't know.
Are you optimistic for 2025, Paul, in terms of your portfolio?
Not as much as I was, because I think we're just getting more profit warnings. We've obviously got the significant impact of the higher employment taxes and the higher living wage yet to be digested by companies. It feels almost like we're in kind of bordering on recession. I saw that the European PMIs today went into recessionary territory. You know, it just feels generally difficult, the macro, doesn't it? So yeah, I've moderated my macro view. I'm not quite as positive at expecting a recovery as I was, say, 3 or 4 months ago. But who knows? Anything can happen.
Yeah, I'm quite a bit more positive, actually. I actually think for small caps we're going to have a cracking 2025. I haven't done as well as you have in 2024. It's been a grind for me. I've had as many profit warnings as I've had sort of upgrades, which hasn't been many either way, and I haven't done any takeovers whatsoever. So it's been sort of like pretty tough sledging, so to speak. But I look at my portfolio and certainly sort of quality small caps, and I am really positive because they're extreme value, low valuations. And I don't think you need a strong macro backdrop. What you need is earnings delivery in the small cap sector. And if you get that, then that will be the catalyst.
Yeah, I think also, I mean, in the last week or two, my watch list is just filling up with so many companies that I like and that I'm now seeing really compelling valuations again. So the value investor in me, and I'm a bit of a hybrid, I get excited and sometimes like some growth and story stocks as well. We all like the occasional story, don't we? But I think, I'm genuinely getting really excited again about valuations, which is why this week I've marked loads of share companies that I've looked at on my Substack. I've marked them as green, because I think you're getting some very attractive valuations, and that's the time to put the money to work, isn't it?
Yeah, no, you're right. Okay, good. Let's just say a big shout out to our sponsors. Everybody knows. Just put the website on there. As you'll know, Paul, we haven't now got a ticker at the bottom, which will be a delight for Dave McCab because he gave me a real roasting last week on social media about it.
I know. I'm sorry, Paul. I did overreact to it, but I didn't like that banner, as you probably gathered.
Yeah, but no, you weren't the only one. It was Dave McCab, I think, who basically put it. But anyway, I'd like to. I don't know whether if you put a review on there at all, Paul, in terms of on the Good Money. I've put one on for AJ Bell. I don't know whether you've done one for
I haven't done one yet. No, because I've been too busy looking at my own. People have left about 20 reviews for me on there very kindly, all bar one of which are extremely positive. And even the bar one was still pretty positive. So no, thank you to everyone who went on to Good Money Guide and left me a review. So it's nice to have a sponsor where actually we've got things working in both directions positively. So yeah.
Yeah, and if you do leave a review either on Paul's or on the Vox Markets one, then you can get a 50% discount to their subscriptions, which is it's a paid for sort of like research service. So it's well worth doing that, no doubt about it.
Yeah. Okay, good. By the way, Paul, that cab, the blue cab with the Good Money Guide thing on it, it's real. Oh, yeah. It's not a mock-up, apparently.
Oh, okay.
Yeah, I said I'd definitely be up for riding around in it in London and just stopping and randomly picking up investors and interviewing them in the cab or something. It sounds great fun.
Yeah. Have you just as a have you bought any or sold any shares this last sort of 10 days, 2 weeks?
Yes,
Last week.
yes.
What?
I changed my mind on AD facilities by ADF. I bought those immediately after the profit warning, but I hadn't seen the broker figures, and I thought the broker update was so way below what the trading update seemed to be saying. So I just thought, oh dear, I think I might have made a mistake here. So even though I can see longer term attractions to facilities by ADF, I don't really want to be just sitting there waiting for an upturn in the TV industry. So I sold those for a small loss. I'd only held them a week or two. So I think that was a mistake. And I recycled that money into Vistry, the bombed out large cap, actually. I think it might even be FTSE 100 house builder that's had a lot of problems. I think that's oversold now. So and I topped up again the next day when it dropped another 7%. I think it's finally looking as if it might be bottoming out today. So I think those are as far as I can remember, those are the only trades I've done this week. So
Okay,
how about
good.
you, Paul? Anything?
But yeah, I mean, just on, just the format of this, just for investors, is that the other one person sort of like talks about a stock, and the other one deliberately and has been told by the other person to act as devil's advocate. So just on Vistry, the one thing that I would look at if I was a shareholder is they go forward capital creditors, because it won't be on their balance sheet. It will be basically their cash flow, because you can have a really strong looking balance sheet, but actually if you've got a lot of capital creditors, like, hundreds of millions to buy land that you haven't been paid for, that you've signed up to do it,
what sort of capital commitments you mean? Things they're committed to spending?
Yeah, the long-term capital credit. That's why you have such a negative, working effectively huge creditors bill. You have a really low working capital in terms of debtors and creditors, because the creditors includes capital creditors, which are not working capital. It's basically it's buying land to, in the long term, that when it does get planning permission, or you've bought it over 3 years and therefore you phase that payment over 3 years as you start selling that land and the houses on it. That'd be the only thing I'd look for with history.
Yeah, I mean, there are lots of negatives with Vistry that obviously have all been in the press lately. So I'm not dismissing those at all. What I'm just saying is I think valuation, it's overshot, I think. And I mean, the inventories are incredible. It's got 3.2 billion in assets just in inventories. So, carrying 600 or 700 million of debt is no issue. I think it's much, but obviously it's a problem share. That's why I'm getting in, because I think it's deep value now, but time will tell.
Yeah. Anyway, like you, I've actually bought one. There's a question coming in from Ben Sharman. He's asking me any thoughts on CML, which I introduced. I highlighted to investors. Yes. I got that wrong in terms of the half-year results, because they
were not good, were they? No.
Well, basically, I sort of like gave this update at Mello on it, and we talked about sort of at CML. It's basically a communications chip business, so it doesn't do NVIDIA GPUs, it doesn't do Intel CPUs, it does niche communications like amplifiers, it does filters, and it does straight sort of like super fast broadband sort of for sort of chip shots. Anyway, with its half-year results, it basically said it was all on track and the long-term picture was good, sales are fine, but its profit was going to be, it was going to struggle to hit its problems. And I've put it as a veiled profit warning. And that was simply because they had this problem where they've just bought this company out in the States, and they got delays on getting planning permission to integrate it. And there was a few sort of one-off costs as well. Anyway, I took that opportunity when it downed by about 12% the shares to top up. So I actually bought on the day. Which I'm delighted about, because I needed a couple more. So I still think it's positive, but it's a show me story, isn't it? I think that's where we were last week in terms of
because we talked about this one last week, didn't we? And I think we covered all the basics on it. So it was just the results that came through. Revenue in line, current trading persists, it will become challenging to meet the full year expectations. So they are warming us up, aren't they, for a profit warning? But you were right to point out as well, you've got the nice asset backing with all the property and the cash. So it's a hybrid share, isn't it, really? I think it's not bad. I don't think it's a bad company at all, but it's never scaled up. It's always sort of bumps along, making a reasonable profit most years. And I'd want to, again, we're repeating from last week, but I'd want to see what the catalyst is to actually get some transformational growth coming through.
Yeah, and I think you're spot on. It's scaling up. Okay, anybody wants to ask Paul or myself any questions, please put them. We've got tons here. Let's go for the one which is the most popular. It's JD Sports, and I think
Oh,
they
yes.
reported this week, didn't they? And I know you liked it. Give us your latest thoughts on JD Sports, which is that English. It's basically UK and increasingly US, effectively sportswear retailer, isn't it, with Nike shoes and stuff?
It is. It's a. I think they call it sports fashion, don't they?
Oh,
So,
that's it. Yeah.
yeah, quite glitzy stores. It's as you say, it's dramatically grown, mainly through US acquisitions. I mean, you're talking about now a business with forecast revenue of 11.6 billion sterling. So this is a big business. It basically, which I've admired for a very long time. I mean, if you look at the long-term chart, it's been an incredible major multi-bagger from the early days. I mean, it was 2p. No, that can't be right. Yeah, it was. So it's been 2p back in 2005. So it's 50 bagged even after the recent falls. An extraordinary business. Anyway, basically it warned on profits, but it wasn't that bad. It was a Q3 update. This is this week, saying we're going to be at the lower end of the range of expectations. But I think the range was quite broad. It was about 955 million pre-tax up to 1,030 million pre-tax, I think, roughly those figures. So far from a disaster. But anyway, and the shares had already dropped a lot in the last few months. I mean, it peaked at £1.60 in September. It's now 95p. Well, I think that, again, a bit like Vistry, I think that's an outsized downturn. And I think it's very, very good value now. Let's see if the revised broker forecasts have come through. No, I don't think they have yet. So it's a slight miss, basically. They've just said current trading is a bit soft, a bit volatile. I don't believe, anything is going fundamentally wrong with this business. And you can now buy it on, you're talking about a single-digit forward PE. So I think it's very attractive. I almost sold my Vistry to buy some of these, actually, because I only keep a small amount of money for my sort of falling knife trades. But yeah, so I think I have to say, I haven't bought any myself yet, but I think if it dropped another 10p or something, I'd definitely sell something else and buy some JD Sports. It's a very good business, and I think this is a relatively minor patch of soft trading.
I think you're right, actually, because I mean, I'm not a great sort of expert. I'm not an expert at all in terms of sort of retailers, but actually, in the sports arena, what's happened is that during the lockdowns, Nike went 10 bells for their direct to consumer model and then fell over on it. They've now realised actually they need to have a multi-channel strategy, and they lost market share to the likes of Hoka and on shoes or something, on holdings, I think it is, which is, so there's a whole lot of new, so and Adidas and people like that. There's a whole lot of new sneakers and trainers which have come onto the market and taken the shelf space from Nike, from the likes of JD Sports. So actually these retailers are in a much stronger position. You've got these guys now dead, the biggest dog in the fight, desperate to get shelf space, and therefore they're going to get really good margins, because they realize if they're going to sell a $200, $300, $400, $500 sneaker, they need actually a physical presence. You can't just rock up and sell it through the post, because people want to sort of touch it and feel it and see it before they spend that type of money.
Yeah, very good point. Yeah, I did look at Nike shares. I saw they've been under a considerable amount of trouble, but I think JD is just a great business and very, very cheap at the moment. So yeah.
Good. Okay, well, let's move to, we've got Abel. He's coming in with CMC Markets, which has been an absolute darling, and I know it was one of your star selections for 2024.
It was.
What's your sort of take on it? Because they did not, it's pretty good results, but the shares fell about 10-15%, was it?
Yeah, and they've fallen another 7% today, which I just don't really understand. I remember I read through and wrote a report on the results yesterday on my Substack, and I was scratching my head really to think, why has it dropped? It was in line with expectations. I think there's quite a wide range of outcomes for the full financial year, because being a business that's linked to stock market trading, it can have wild gyrations in profitability, but it's got a very, very strong balance sheet. This was one of the original reasons I picked this at £1 a share at the beginning of January 2024 for my top 20 share ideas for this year. One of the key reasons was that I was getting the business for free, because it was only valued at par with its own cash and near cash, less all liabilities. It was absolutely ridiculous. The business was literally in for free at £1 a share. And then they slashed a load of costs and suddenly reported that H1 profits hit 50 million quid compared with a minus 2 million in H1 last year. But it had all been preambled, in trading updates. And there was actually a very slight miss on the H1 profit figure compared with the trading update a few weeks ago, which is not ideal. You want your FD to keep a little bit in his back pocket, not to tell you the profit's going to be 51 million, then announce 49.6. So that might have, although it's not material, that wasn't a good look. But the outlook was in line. I think it could do anything between 20 and 30 pence for the full year. So I think it's a very good business, actually, reasonably priced. I don't really understand why it's been dropping the last week. We're just in a very jittery market, I think, where particularly if people have tripled their money in a year like they have on this, I think they'll jump at any opportunity to bank the profits. So I'm not too, I don't think there's anything wrong with the investing thesis on CMC Markets. So over to you, Paul. What do you think?
Yeah, I totally agree. I mean, I think this is a classic signal and noise. If you look at it's dropped a bit, but I'll just class that as noise. Look at where the chart has moved and the company's performance. I mean, the profits over the last 2 or 3 years have soared, and the revenues have. They've created a platform. They're selling into third parties like Revolut. You just got to basically accept that things don't go perfectly all the time, and there's a case you're moving into sort of new territory, and there's going to be a bit of rocks you're going to have to go over. But that's just noise. That is long term. If you're a long-term trend, long-term holder of this sort of stuff or investor, then I wouldn't worry about it at all. I mean, that's nothing, 10, 15%. That'd be my take anyway.
Yeah.
Okay, good. We've got another question.
I think that's reasonable. And
we've got another question coming in. RP Invest. He's asking about hVIVO, and this is quite interesting because this one does challenge trials down in London. It's got some facilities, and it basically helps biotech with businesses test, say, vaccines on healthy individuals. It gives them an infection, and then basically the vaccine comes in, or a drug comes in to help get over that particular infection or so. But the shares have dropped of late. I don't know if you got any read across on this one at all, Paul?
Yeah, this was one of the ones, funnily enough, that's got. Yes, hello.
Yeah, Paul. Yeah,
I can hear you. Okay, can you?
Yeah, no, I can hear you. Yeah, I can hear you now. Me? Yeah, I can now.
Yeah. Sorry about that. The internet here sometimes goes a bit wobbly, but yeah, I think hVIVO looks very good. I like the company a lot. I have no idea why it dropped so sharply over the last few weeks. No idea at all. So that's one that's on my sort of potential buys list.
Yeah, I don't think nothing's been disclosed at all. But
no.
my take on this RP Invest, is that it isn't. You haven't got to be a rocket science or even a biotech scientist to realise the fall started when Trump came in. Okay, and the reason
that's interesting. Yeah. Okay,
and the reason why that you might want to put the dotted line together, and this is a very fake dotted line, and it's my dotted line, and 40% of my dotted lines are wrong. Okay, so take it with as much of it. But he came in with Trump, and he's just basically put in at the head of as the health minister, the NHS equivalent of their minister there, a guy who hates vaccines. Okay, he was basically against the COVID vaccine. And so what I think the market may be saying is that he's basically, this new guy is going to have a go against anybody making vaccines and stop the production of vaccines. And if that happens, then it will impact the amount of challenge trial testing. Hey, that is just a very, very nebulous and cloudy explanation, but it just seems too coincidental that it's dropped off a cliff with Trump.
Yeah, no, I like the idea. That's I must admit I didn't join those dots up. So, but that sounds the type of thing that would actually be more a buying opportunity than a threat, I would say.
Yeah, no, I agree. I think it's absolutely. Put it this way: are we going to stop having vaccines? Are we going to stop having infectious diseases? Of course we're not. It's rubbish.
Yeah.
So it's right on my stock watch list as well. I don't think there's anything untoward happening with the business whatsoever.
No,
Okay.
it's fundamentally a very, very good business, I think. Amazing
Yeah.
turnaround there in the last 2 or 3 years. So yeah, I like hVIVO.
Okay, good. Okay, let's switch sectors. Let's go into the skies. Let's have Jet 2, because this one
Yeah.
has been a huge, massive multi-bagger for, well, for investors over the last sort of 5 or 10 years. It basically does package holidays and also has its own airline. I think it ordered a whole bunch of Airbus as well, because it's growing so fast.
Yeah.
But,
Yeah,
what's
it's
your
got
sort of
loads. Sorry, Paul.
what's your sort of thesis on this one? Well, because I mean, most people sort of like look at airlines and think it's a sort of like a you've got to have a fair risk tolerance to go into airlines. They're trades rather than investments. But how do you see it?
Well, this is my sector pick, and it has been for a long, long time, actually, jet2.com. I don't own any of these, so I'm not talking my own book here, but even though it's out of the small cap space, it's 3.2 billion, I tend to write about it in my reports because I just think it's a lovely business with a great long track record. And it's niche, really, in that it serves a lot of relatively minor airports where it has much cheaper sort of landing arrangements. It's not competing against your British Airways or your flag carriers so much, because it goes from these secondary locations. Originally owner managed, incredibly astutely run. It's been a massive multi-bagger long term, and everything they touch, they seem to do brilliantly well. The customer service is exceptional at Jet2. Everybody you speak to who flies Jet2 says it's a great experience. And it's reason and basically it's got a bulletproof balance sheet. I've always loved the balance sheet at Jet2. It's got mountains of cash, and of course it gets cash up front from customers that it can invest and earn interest on. So very large amount of finance income. But the reason I'm flagging it today, it was one of my top ideas for this week, in that it put out sparkling H1 results, I think it was, wasn't it? Yeah, that's it. Covering the main holiday period. So it's H1. It makes more than 100% of its full year profits in the 6 months to September. The figures were superb. It's raised its full year guidance. I think one of the brokers upped the guidance by a fairly substantial amount, by 10% or more. As I say, you've got everything lined up here. You've got a low PE. You've got a fantastic balance sheet groaning with cash. You've got the orders in for the new planes, and because there's a big backlog of new planes, actually, if you've got fixed price planes on order, there could be instant profit in the value of those as well, I believe. So yeah, not really a sector I would normally consider investing in, but whenever I look at the numbers for Jet2, I just say, God, this is so good. I've got to be green on it using my traffic light system. So yeah, don't like the sector, but love this share. So how about you, Paul?
Yeah, I mean, Brits love a cheap sort of like all-in-one sort of package holiday, where everything's paid for and you can just get onto a plane and allow other people just take responsibility to pick you up from the airport and take you to the hotel, and all you got to do is drink cocktails by a pool.
Yeah, and the thing is, Jet2 only started doing that a few years ago. It was originally just an airline, but they started doing the package holidays, and they're doing incredibly well at it. I think EasyJet have copied that and tried doing the same thing as well.
Yes, they have actually. Yeah, you're right. Yeah. What's the forward bookings like for this business? I mean, I did see Ryanair at some point saying it was seeing stable but not going up pricing, and I think it had less visibility on its forward bookings. But I don't know what
I should know, but I can't remember, Paul. Sorry.
Yeah, okay, that's no problem at all. Okay, good. Got a question coming in from Lemon Physical. He's asking about Springfield Properties at all. Have you ever had a look at that one? It's basically it does. I think timber framed properties out in Scotland.
Scotland, yeah. I was thinking
house builder, isn't it? Yeah. It's cheap, I think, and it did have a debt problem, but I do believe it solved that one. It had to reduce its debt.
110 million market cap after today's rise. I'm ever so sorry again. I can't remember anything specific about this. I mean, all I would say is, looking at the chart, it's not been beaten up as much as many of the house builders have in the last 3 months. It's come off a bit. Yeah, it's 0.7 times tangible book, which is nice and cheap. I think you're right. There were some debt problems there. I can vaguely remember writing something about this quite recently and thinking it was looked all right. But I didn't know that one was coming up, so I didn't prepare for it, I'm afraid. Sorry about that.
Yeah, I mean, looking at the value, I think just off the top of my head, I think the net tangible assets is round about 90p to a pound. So it's trading at slightly less than net tangible assets.
Oh,
But it's
I've
still
got a much better figure than that. I've got price to tangible book of only 0.7 times. So that would imply tangible book value of about what, £1.30-ish, wouldn't it? Or
yeah, okay.
£1.25.
So it still looks cheap then, basically. As long as they
Yeah,
as long as they don't have a capital creditors problem, then they should do fine to a certain extent. I know
yeah, yeah.
they've got this huge. I think it's sort of like a 2,000 or 3,000 property type of greenfield site they're building out in Stirling. I think it is. I remember reading
Okay,
it's enormous. They've got it with one of the big national land builders that they're doing it. So
right.
they should be reasonably well insulated as long as they can sell it, I guess, is the key.
Yeah.
There seems to be plenty of opportunity, I think, in the sort of the building products and house builders area. Well, certainly the building products, and more so now the house builders. When it came in the budget, they didn't nail all of them with that land uplift tax that everybody thought they were going to get for getting planning permission.
Yeah, well, that's right. I mean, we've all been waiting or even anticipating, haven't we, the recovery in the house building sector? But it's looking as if it's a lot more tentative and slower and more hesitant than we originally thought. And there was an interesting update from today from one of the ones you like, Michelmersh Bricks,
Yes.
MBH, where they basically that I thought was quite encouraging. They seem to be saying that orders are picking up a bit. There was something they said about today about order intake now exceeding factory output, and I thought that was
Yes.
quite interesting. And they're
Yeah.
doing so they said they're trying to build a sort of balanced order book. So it seems to me, from what they've said and several other companies have said, yes, we're probably going to get some uplift in house building and building supplies in 2025, but maybe not a V-shaped, maybe a more gentle and gradual recovery, I think.
Yeah, these guys basically make. I own them. I've owned them for about 10 years. They make premium bricks, and there's a trend, obviously, to premiumization, even on affordable homes, just to make them look good. They do these really nice, sort of like, aesthetically pleasing and contextualized sort of bricks and stuff like that. And the interpretation I got from today's statement was that they were basically forward selling a lot of their volume going forward. So they sell to distributors a lot of the time rather than to the house builders, and so they've received a lot of orders that cover all of because their biggest cost is energy, okay, and they're forward booked a lot of their energy, and so they need a good visibility on their order intake that makes them a good profit. And I think what they're doing is locking in profit for next year.
I got that impression as well. It was slightly oddly worded update today. The only thing I'd throw back at you, again with my devil's advocate hat on, is that if you look at the 10-year chart on Michelmersh Brick, it's just really oscillated sideways. Now, I appreciate it does pay nice dividends. The yield is currently 4.7%. So if you were to do a total shareholder return graph, it would be gently going up. But given that, I mean, are you so you said, I mean, why have you held for 10 years then, Paul?
Because I'm a long-term investor. This is a trophy asset.
If it's just going sideways, wouldn't you at some point say, look, there's something better to put the money into?
According to Investors Chronicle, about 4 weeks ago, on one of their podcasts, the board had been approached by Fortera to buy it. These guys are a trophy asset, okay? And the board, according to Investors Chronicle, rejected their approach, But this one, when it's bought, will go for sort of like £1.60 to £2 easily, if not more. I mean, it's trading at a discount to all the others, you just unlock. That's the whole that's the whole sort of like difference between, when you look at companies on a listed basis, you take all their effectively overhead costs and fixed costs that into profit. But when you look at it on a takeover target, then that's why you value it on an EBITDA basis for for a lot of these type of businesses, because you can just wipe out all the overheads. And I'm sure
that makes a lot more sense now.
And I'm sure the thing is such that the private valuation, would be, significantly higher. But I think the problem that Fortera have and Ipstock have is that their balance sheets aren't sufficiently strong enough to put a sort of like a £2 figure on it. They can't get the foot. I think they'll struggle because they've still got quite a bit of debt that they need to actually get rid of themselves. So anyway,
yes. I looked at. I wrote a section on Michelmersh Brick today in my Substack, and I looked at the balance sheet, and I thought it was very good, nice ungeared balance sheet at Michelmersh, as you say. And I think this was the one where I read they make these kind of almost like fake bricks. I can't remember the name of them.
Brick slips.
Sorry.
They're called brick slips, but they put basically a half brick, and they also do the cladding as well. Bricks to replace the cladding.
And I thought that was very interesting because I'm sure I've seen some new build things around here in North London where they're throwing them up with sort of breeze block construction, and then they put these sort of fake bricks on the front of it, and it looks to be a very efficient way of building new builds, I think. Yeah. They've
been doing that for years. It's called brick slips. Yeah, they're specialists at it. Basically, it makes an affordable house, built, social housing, look really good.
It does.
They do the same on things like King's Cross, all the railway stations. They do them in schools. They do them in buildings, and it just means that you look at the property and you think, "Fab, this looks absolutely terrific." It's like Hogwarts or Buckingham Palace or something like that.
It's a great idea, isn't it? Yeah,
it is. Yeah, it's good. Okay, let's keep that sector because I know one really like Norcros, which basically does was it sinks and plumbing stuff, I think, and nice.
It's sort of mid to high end. Middling upper, slightly upper bathroom fittings. It's been acquisitive because the problem historically with Norcros and why a lot of people avoid the shares is because of this huge giant pension fund. Now, the point is, so what they're doing is they're making bolt-on acquisitions because it's a nice cash generative business. They're paying reasonable dividends and doing a series of acquisitions without letting debt get out of control. Well, I did a detailed write-up of it back in June, and I actually flagged to people that the legacy problems now are very small. And I reiterated that again this week with an update article on, when was it? Is that saying I did it today? No, that's not right.
It's been a long week.
It has. No, it was yesterday. That's it. Yeah. And So I checked all the numbers again, and basically the payments into the pension scheme now are only equivalent to 10% of pre-tax profits, which 10% really neither here nor there, because they've diluted the pension fund by just making decent acquisition after decent acquisition. So Norcros has demonstrated that they're actually really good at buying and building, and it's largely resolved the pension scheme issue. And the other issue is that it's got these South African operations, which obviously have been problematic and very volatile. Well, those again are now so immaterial to group profits that I just disregard it. I just value the share on its purely its UK profits, and it's cheap. So again, the political and economic risk of South Africa, forget about it. It's so small to the group profits, it doesn't matter. And I think maybe the market is starting to gradually realise that, because as you got, is that the chart there you got up for?
Yeah, it is. Yeah, no, it's gone one way. For building products, it's like Almasac. It's one of the very few which has done really well.
Yeah, it's done very, very well in a tough small caps market. And I think this is partway through a re-rating from where it would always be on a PE of 5 or 6 because of the pension deficit in South Africa, to the market gradually realizing actually those don't matter anymore. So you could value it on a PE of 10 or something. And I think I think it's halfway there. Yeah, so I like it.
What kind of quality products are there? Because the reason why I say it, because you do have these sort of like sector experts, and they have you have Dunelm in soft furnishings. You have basically there's another one. Oh god, I could just slip my mind. But there's a few of them which are just they're basically premium products, etc. And people always sort of migrate to that. That are these guys?
Triton Showers is the big one, isn't it? That everyone knows.
Oh, okay. Yeah.
And it's got quite a few different brands that it's acquired. Yes, I mean that's all be on its website, but they seem to have good pricing power. The only thing is they get everything manufactured in China, so that worries me a bit. are they going to be disintermediated by the Chinese flooding the UK direct? But I don't know. But
yeah. But you do get these. The other one is Next, and it's sort of like people just migrate to a brand that they love. And
yes,
that's right. The one I was thinking about was Howden's, because another one is Howden's Kitchens. Those kind of companies, through thick and thin, because people love the product. If effectively, basically what they call it, Norcros has those type of brands, then they should do. They'll be able to sell anyway.
It's got pretty good brands, I think. I like Howden's. I had a look at that recently, but it wasn't cheap enough for me to buy any. But you're right. Everybody knows their kit's good, so you don't even bother shopping around, do you? The trade buyers just go straight to Howden's.
Yeah.
Brilliant.
Okay, good. Right, I'm going to test your brain now, because I've got a stock idea, which is coming up with results next week. It's Auction Technology Group, okay?
Oh, yeah.
And this one basically is a bit like a cross between Rightmove and eBay. What it does, it's got the technology. It connects the auction houses, thousands of them around the world, with bidders for curated high value sort of products in art and and antiques, and also sort of commercial and industrial equipment, things like forklifts, etc. And what's happened, it was a darling. It got listed. I can't remember exactly how much, probably about £8. It went to about 16 quid or something.
That's right. Yeah.
Yeah. And then has dropped back down to sort of like, £4.30 now. But what it is, it's got huge networking effects, because you can't invent the bidders, coming onto the product, coming onto the site, and you can't also replicate all the sort of the auction hours, and literally thousands of them. And what they've done is that they've taken that sort of like networking effect, and they're starting now to add on new services, things like payments. They're doing shipments on it. They're also doing cross marketing. So effectively, an auction house now can put its product out not just to bidders who've gone into its particular auction house, but to all bidders. And their margins, they make roughly EBITDA margins. They made 42% in the first half, but actually in the second half, I back calculated from their recent from their trading update last month, they've done 50% in the second half, and that's what they were doing sort of historically. They're just they're a cash generating monster. They're basically their second half net debt has basically gone down to below about 120, and it was over $140 million only 4 or 5 months ago. And their EBITDA, their net debt to EBITDA has dropped from 1.9 to about 1.5. I just think this is a high quality business. I think it trades at roughly around about 15, 16 times PE. But the reason why I mention it, I don't own it, okay, but it's right there on my stock watch list. And I would say have a look at the numbers which come out next week, because I do think it's got all the hallmarks of really huge economic moat with really high margins. And if it can continue grow in terms of that secular trends moving from physical auctions to online auctions, and frankly, it's a damn sight easier buying something online than having to go around to sort of like Plymouth or Peterborough or something to see something, then they should do well. I don't know if you ever had a look at this one.
Yeah, I've looked at it quite a few times. I'm actually quite negative on this one. We've had a lot of debates with the readers about it. The trouble is, I think it's looking like a mature business. I think I've heard from the readers that they are accused of sort of price gouging and overcharging. That there are competitors apparently now chipping away at them. The balance sheet's weak. I just don't like it, Paul. I think
that's interesting. That's amazing, isn't it? Because we're both basically GARP investors. And you don't like it because basically it looks as though, which I can't defend, because the take rate for their art and antiques is 9.5%. It's only 2.5% for their other one. So yeah, I mean, I don't know how competitive that rate is, but that's amazing, isn't it? How two people who look at a share, one thinks, if anything, I think there's upside, a lot of upside on it, but you think there's a lot of potential downside.
Downside, yeah. I mean, yeah, no, no, it's not for me, this one. I just think maybe it's I think it's X growth, and I think it's being chipped away at by competitors.
Fab. Okay, good. Well, I like that. That's brilliant. Okay, right. Now let's move on to industrial chain manufacturer. Let's go to Renold, because I know that came out with a trading update or some results this week, and I think you
It
quite like
did.
this one.
Yeah, yeah.
Yeah.
I've been a long-term bull on this. It's been a long, slow, painful turnaround. But I remember presenting this on Mello online when it was about 14p, and it's it's risen to about 4 times that. It's given some back. This was another one actually where it put out inline results this week, and the price dropped about 12%. It's just such a jittery market at the moment. I couldn't see anything negative in the results. It was roughly a flat performance. It makes a good operating margin. H1 was kind of flat against last year. Well, I think, what do people expect in macro that's as tough as it is at the moment? To me, a flat profit performance is a good performance, because there are plenty of companies reporting plummeting profits. It's got very good pricing power, Renold has, because it's a long-standing Manchester-based, I think, industrial company, and I've spoken to the old management multiple times. No, I actually think it was the current management, and he basically said some of the customers will pay up to 5 times the price of a cheap Chinese industrial chain. They'll pay 5 times the price for a Renold one because they know the Renold one won't break. And they've got a lot of defensive characteristics, because these industrial chains are typically replaced on a fixed schedule, irrespective of the economic climate, because the cost of the chain failing because it's been used for too long is too disruptive to the client. So it's got a lot of positive features, Renold has. The downside stuff, I would say, is that it's got this big pension deficit. So the pension deficit is very cash hungry, 7 million a year. So you do need to factor that into your calculations, because, of course, deficit overpayments do not go through the P&L. I didn't realize that until only a few years ago, actually, because but I think a lot of investors don't realize that. So your PE of 5.4, a fair bit of that is a discount for the cash that's being consumed by the pension scheme. But it's also doing something similar to Norcros in that it's building the group with buy and build type acquisitions, which gradually dilutes the size of the pension deficit. So I think I think this recent dip could be presenting us with a buying opportunity, because basically nothing's changed. The management incentives, I think, are far too generous at Renold. That's my main criticism. The employee benefit trust siphons off substantial multi-millions of pounds to buy shares, which are then basically given to the directors free if they hit targets that properly set so that they can meet or beat them. So that is a fair criticism, I think, of Renold. But I still think it's attractive. I think we're probably pausing in an uptrend rather than there being anything wrong with the business.
Yeah, no, I'm with you. Again, I think it's a signal and noise, isn't it? If you look at the chart and you look at the actual performance, the only one thing I would say, I think it is slightly dependent on China, because obviously all the big miners, like iron ore and copper and all the industrial metals, go from things, go from the big miners into China. And if China's weak in terms of its infrastructure, then there'll be less mining and therefore potentially less usage of those chains. But that's at the margin. I mean, I'm clutching at straws to get anything which is of note, because if they've got that type of brand and they're effectively the go-to person for industrial chains in the industry, it's not price sensitive. They've got pricing power, which more than sort of like compensates for any other negative. That's for sure.
Yeah, and I think because they know they are global now, Reynolds, as well, and because they know their niche so well, they know what to buy. Where they do bolt-on acquisitions, they know that company inside out already, because they probably had dealings with it for decades. And I think that isn't it? Oh, one of their factories was hit by the floods in Valencia.
Oh,
recently.
That's right. It wasn't it? Yeah.
Yeah, £1 million hit, and I think they said they can absorb that within the forecasts. I'm not muddling them up with another company, am I? I can't. I think it was Renold.
Yeah, it was one of them, wasn't it? You're right. I
Yeah.
remember hearing about it. Yeah, yeah.
Mm.
Okay, good. Let's. I've got lots of questions coming in on
Okay.
equals, which has got this perennial put up and shut up. Okay.
Yes, what's the
I bet.
latest? Yeah.
I know.
Is it
Yeah. I bet.
the 94th deadline has been extended?
I know. It's only been going for just over a year.
Yeah. So what's going on then, Paul?
Okay, well, basically the announcement which came out on Wednesday was basically saying all the due diligence now is being done and the funding has been done for equals, and the documentation has been done. But because the consortium has got two VCs, it's got JC Flowers and it's got Towerbrook. The Towerbrook part of that consortium is injecting its own company into the merged entity called Railser. And yet at the moment, Towerbrook and JC Flowers haven't yet agreed a price or the valuation that then gets put in as the consideration from Towerbrook into the merged entity. And they're obviously throwing handbags, these two guys, at one another. I suspect, okay, and who knows, but if they don't sort themselves out, I actually think they'll walk. I've got a sneaky suspicion equals might well walk away. I know it's been a hell of a long time, but I suspect they will because they've done. It's not their fault at all. But I would say what's really interesting because I've done the numbers. I've recut. The thing is, because it's been a blackout period for a year. Okay, we haven't done any research. You know, we haven't done any brokers from like Canaccord or anybody like that putting numbers in. Yeah, but reading from their Q3 update they did in September on the back of their interims, I think they'll do roughly around about 125 million turnover this year and about 10p of EPS. Okay, and just to give people perspective because lots of people have been bashing the management team. That's quadruple what they were doing 4.5 years ago in terms of turnover. So they've quadrupled the top line, and not surprisingly, the share price has quadrupled. So let's give them a pat on the back for that. But anyway, if you then push
you're way ahead of the broker consensus, though, Paul. The broker consensus is 7.2p, and that has been steadily edging up for in the last few months. So why are you so far ahead at 10p?
Yeah, but 7 point is rubbish because they did 4.2p in the first half, and that was on 60 million of turnover. They'll do 6p of EPS in my view in the second half. I could be wrong, but that's what I suspect. Okay, on about 120 to 125 million of turnover, I think they'll do. But that's not the story. The story is, and this is why I still hold. I mean, this is my biggest position. You know, I think they'll do between 155 and 160 million of turnover next year at about 12.5p of EPS. Okay, now this is the way that you look at this business, because about 25% of that EPS is interest related. Okay, drop straight down to the bottom line. So let's put an 8 times PE multiple on that, after tax multiple on the interest, and let's put a 15 times multiple on the rest of the business, which is growing at 25-30% per annum. Okay, and it's scalable with 50 to 55% gross margins. So if you do that, then you get a fair value of about 165 to 170p. So I think, I mean, I got lots of questions at Mello on Wednesday. What's your view on equals? And I said to them, I don't care. If it goes ahead, okay, it goes ahead, and I get a cash and I'm going to invest it in a lot of small caps that I really want to do. So that's not a bad outcome. But if it doesn't go ahead, it'll drop. Of course it will, because you've got arbitrage guys in there. But in 3 months' time, they'll put their prelims out. People will say, this is like a money-making machine. It's going gangbuster. And it's on a really cheap valuation. So it will go back. It will go up of where it currently is. So I actually think as long as I'm a patient investor, I've held this for 5 years. I mean, you just got to basically look through the pain and the frustration. I mean, just think how painful and frustrating it is for the management team, who have quadrupled the performance of the business, and they're getting criticized by a whole lot of people for for this strategic review. And I think that, to be perfectly honest, they've done a great job myself. But hey, I'm only a long-term investor.
Yeah, well, I mean, the market price is now at £1.18 is telling us that the £1.37 bid's probably not going to happen, isn't it?
Yeah. Well, I think he's got to have doubt, because if they can't, if the VC guys haven't been able to sort it out by now, when are they going to sort it out?
Yeah.
So
no, interesting. No, thanks for the update, Paul. As I haven't really got anything to add to it, as you know, I'm not keen on this sector. So I'm just neutral on the watching from the sidelines with fascination to see how it'll pan out.
Yeah. Okay, we got one question coming in from Simon Rowan. He's asking about Spectra Systems, which I know you quite like.
Yes.
It does basically authenticating currency and plastic. I need a glass of wine, don't I? But
they presented remotely. It's almost a one-man band. It's run by a boffin called Nabil, I think, isn't it? And he's an absolute force of nature. He's an incredible guy, and he appeared by video link from America at Mello recently to a packed room. It was literally standing room only, and it was tremendously impressive. I've been in this for a few years, actually. I just think it's a remarkable business. Basically, they've got 20 boffins in the company who are just brilliant at inventing things and selling security products and services for enormous gross margins. I mean, he was just saying, we aim to make a 90% margin on our products and services, and he's an incredible guy. If people can, and it's not BS, because he's delivered over many years. This is not blue sky. This is a profitable company that's very profitable company that makes a huge profit margin. It's growing, and yet it's on a forward PE of 7.5, and it pays generous dividends. You've got a 4% dividend year. I should caution that, though, by saying that every 3 or 4 years they get a really large bank sensors contract from a major central bank. So they're kind of deep in with all these big central banks and provide totally bespoke services for them. And so I think it's the year ending December 2025 is when one of these sort of triennial type massively lucrative contracts is kicking in. So that needs to be seen as a bit of a one-off bonanza year. But I mean, he was talking in the recent webinar about this thing just spewing out cash in 2025. So you might even get a special divvy. I don't know. I just think it's a very, very special business. I can't really think of anything else like it, where you've got these 20 or so boffins who just create all these highly lucrative projects. They've got about 5 projects on the go, and everything they touch seems to work. Polymer banknotes is their latest thing. That again, it's not in the forecasts, but they're in pretty advanced discussions with central banks all over the world about. And they've made a very good acquisition as well. They've bought a postage stamp printer based in the UK and in France for very little, and basically the price they paid for it was more than covered by the machinery that it's got that they needed anyway. But they bought the machinery cheap and all the people who know how to use it. So this one I think is just a buy and just hold it forever, in my view. And I'm pretty confident we'll end up with something more valuable than it currently is.
Yeah, I'm with you. It's got. I know you just say it's a sort of bit of a lumpy contract type business, but if you've got 10 guys who are geniuses, that reminds me of Bioventus.
20 even. Yeah.
Sorry?
Oh, yeah. Sorry, Bioventus. Yeah. Actually, that's a similar thing. Yeah. Small number of boffins who create enormous value. Yeah. Good comparison.
Yeah. Well, you should get a team going there, Paul, at your end. Similar result.
Oh, wow.
Okay.
Yeah.
We got it. That means it stopped picking. We got a question.
I see. Sorry. Yeah.
That's what I meant. We got a question coming from Andrew W. He's asking about U Group at all. I think they're basically a challenger energy provider for businesses in the UK. They've done
one. Yeah. I do know fabulous results, done brilliantly. Shares have done brilliantly. I know all that. I just don't understand the business model. I don't see how a business, a small energy supplier that never made any money before the Ukraine war started, has any sustainable advantage. So I just, I've been saying this for a couple of years and I've been wrong, but nobody can actually explain to me why just a reseller of utilities can make spectacular profits. I suspect it's probably because they've got some favorable hedging arrangements in currently, so I think the big profitability probably unwinds at some point. I just don't see that there's any reason at all to believe this business model has some secret sauce for making vast profits from energy supply. Doesn't make sense to me. But
Yeah.
but I know I've been wrong so far. So over to you, Paul. What do you think?
Yeah, I mean, I'm not close enough to it, but I would say at that at the spike of the energy at the start of the Ukraine crisis 3 years, just up 3.5 years ago, yeah, that wiped out most of their challenger
Oh
competitors,
yes,
and
yeah,
so the
good point.
landscape now is far easier. All they're doing is competing again. They're just cherry picking things like British Gas and Eon and people like that. They're B2B customers. They're just picking them off, and it's an irritation for the big guys because they're winning far more now of the consumer, so they've got the volume. And I think it just is basically all the other the challenger energy providers have gone pear-shaped, which
Yeah,
means that
that's a fair
they're
point. But
snapped
won't
at the.
that surely new entrants and competition will come back? That's my main issue with this. I think I suspect they're making supernormal profits that
Yeah,
eventually get competed away. I just don't see why they would have a permanent competitive advantage. That's my only question.
Yeah, and the reason why you might get a more permanent competitive advantage now is that effectively, what is it, Ofgem isn't giving out licenses to be a challenger energy anymore because they realise
Right.
because it costs the government billions to bail them out, and now they're
Yeah.
not going to give anybody any new licenses unless you're the size of flipping Shell, So I think,
Oh, that's an interesting point. Yeah.
yeah. Yeah. Okay, we've got a question coming in from Shane F. He's asking about Card Factory. And did they have some results or something this week? I did see the shares moved a bit, but don't get that.
No, there were no results this week from it. It put out rather lackluster H1 results, but that was
Right.
some time ago. That was what's triggered that plunge, the sort of
Yeah.
plummet in the share price. The H1 results were quite soft. It was well down on prior year, but they said full year expectations are in line, but that requires a very, very heavy H2 weighting, which a lot of people, including myself, looked at and thought, I don't think that's realistic. So this is why it's on a forward PE of only 5.2 times, because at this point in time, the market doesn't really believe the forecasts. But I think a lot of people, and I agree with this, are saying, well, it's fallen so far now that actually, a profit warning's already baked into the price anyway, and you've got a 6.8% dividend yield. It sorted out its finances, so it got through a period where it had a really, really, it was on a knife edge for a while during COVID. So I think I like Card Factory a lot at this price. Actually, it's on my watch list of potential buys at the moment, and I think that's why you've seen a 5% rise today. Maybe it's just getting so cheap that a lot of people are thinking, like me, that maybe it's time to just buy a few of these.
I know Moonpig have done really well of late, though. I remember looking
Yeah,
at their model seems to have really sort of taken off, but they're not the volume boys like Card, I guess.
yeah, I think there's room in the market for both, actually.
Yeah.
Yeah, Moonpig has been doing well. I didn't go in for that because I thought the balance sheet was really weak, but maybe I obsess about balance sheets too much, but that's just my personal preference. And the shares seem to have disregarded that. But you're right. It is Moonpig. I'm just looking at the figures now. Moonpig's on about 16 times next year's earnings. I think it reduced the debt a fair bit at the last results. So I actually like both. I think Moonpig's not bad, but of the two, I would definitely go for Card Factory in preference.
Yeah.
It's just so much cheaper.
Yeah, I don't think you obsess on the balance sheets at all, Paul. I think you're absolutely spot on. I always view it such that effectively the balance sheet is the red line. If it's any problem, forget it, and then the profit and loss is where the value all lies in. But if it's got value in its P&L and the balance sheet is absolutely terrible, then I won't go anywhere near it, even though I like the investment case, because there's going to be pain ahead, or could well be.
Yeah, exactly. It's all about doing whatever we're comfortable with, isn't it? And the way I look at it is, we've got 1,700 shares to pick from. We probably only need 5 or 10 of a meaningful size in our portfolio. So you can say no to practically everything and just go for the ones that. And if something doubles or triples and you didn't buy it because it was too risky, so what?
Yeah. No, me and you have still got PTSD from the great financial crisis, haven't we?
Yeah,
Because
yeah, probably.
anybody who had debt then was just taken to this woodshed.
Yes,
It was terrible, absolutely
yes,
terrible. So, hey,
yeah,
we both have that sort of like marked on our foreheads, don't we? Okay,
yeah, definitely.
we got a last question coming in. Lemon Physical, he's asking about Macfarlane, and I was just looking at the chart, and it's basically I think it's a specialist packaging business, or is it
Yeah,
basically? Yeah.
it's very
Which
nice, but it just, gosh, it's down to £1.4.
Yeah, I
Wow.
know, yeah. I mean, it's a good spot
Yeah,
there, Lemon Physical. Well done. I mean,
yeah. There's so many things at the moment, that I haven't looked at for a while, and you look at them, and it's sort of 20-30% lower than where you last seen it. So yeah, I've always liked Macfarlane. I think it's a good, well managed, again, a buy and build type thing, self funding, bolt on small acquisitions. Forward P's 8.3, dividend yield 3.7%. You've got some reasonable balance sheet there. I would say I think it's put out a couple of softish trading updates this year.
mm,
I can't remember any of the details of it. And packaging companies is more a distributor. I think it's got a small
yes, that's
manufacturing,
right.
but it's mainly a distributor of specialist packaging. They're never going to be on punchy ratings, are they? Those packaging companies are all on sort of high single-digit PEs. But I've just been impressed with it. And funnily enough, if you zoom out to the sort of 10-year chart,
Mm.
it's actually done pretty well, and you've received a nice stream of
Yeah, you're
divvies
right.
at the
Yeah,
moment.
yeah.
So I think, yeah, I mean, look, this type of share, actually zoom out more than 10 years, and it's done superbly well. It's 6-7 bagged over the last 12 years.
Mm,
That's not too shabby. And this
mm,
type of share, I would suggest, the times when it's in these dip points, that's probably the time we want to be buying, isn't it?
yeah. What's the PE on it? Do you know at all at the moment? A
Forward
forward
PE is
PE?
8.3. Yeah, and they
Wow.
did. Yeah, I mean, arguably it probably shouldn't be on a much particularly higher PE than that, but I would have thought 11 or 12 would be
Yeah,
fair.
yeah.
Yeah, but it's out of fashion. Nobody's interested.
Good. Okay, brilliant. Well, we're just coming up to closing. Before we do, though, I'd just like to say a big thanks to you, Paul, actually, for your Substack, because it's now hit the sort of paywall has come up, and I'm absolutely delighted to give you my money, because you did a fab job, and as I
Oh,
say,
well, I would have given you a complimentary account, Paul, but thank you very much.
no, I
Yeah.
definitely don't want one. No, 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 no. But
Yeah,
I would.
I turned on the subscription engine this morning,
Yeah.
and in about the first half hour, only one user converted from free to paid. So I was like, "Oh no, I've made a terrible mistake." But then, luckily, throughout the day, literally
Yeah.
hundreds of people have paid me the subscription. So I'm so thrilled and very grateful to everyone who's supporting me. So thank you.
Yeah, good. Okay, and I'd just like to say, encourage everybody to put a review on Good Money Guide on their website. That'd be fabulous. Put one on for Paul, and put one on for Vox Markets. Would be great. But it's really helpful in terms of for users to have a look at different providers to see which ones are useful or not, as the case may be. So okay, good. Well, thanks a lot, Paul. Been a long
No.
week, definitely, and
Yeah, yeah, I'm gonna have
look
a good
forward.
rest now.
Yeah, look forward in touching base 3 o'clock next Friday.
Perfect. Thanks, Paul. Thanks, everyone.